Thanks for joining us today on The Close. I'm Morella Fernandez. Markets closed in 30 minutes. Let's get to the stories we're following in the BNN Bloomberg newsroom. The federal government is set to table its spring economic update in a half hour, with the Prime Minister suggesting there will be some good news. Recent data shows Canada ran a budget deficit of $25.5 billion from April 2025 to February of this year, and that's well short of the $78 billion deficit projected in the budget plan. We will bring you that update when it gets going, as well as live reaction from experts on the economy and what it all means for the market and Canadians. TFI today up more than 5%, a star performer on the TSX after the trucking and logistics firm posted stronger than expected sales and profit in its latest quarter. Its profit forecast for the second quarter also came in higher than analysts had been expecting. TFI says the results were driven by strength in its truckload and logistics units, despite adverse weather. Shares of Celestica taking a hit today. They're down more than 15%. The maker of electronic components reported first quarter profit and sales that beat estimates, but investors are noting the results didn't meet high expectations. Celestica also raised its full-year forecast for revenue and profit and expects to grow revenue by more than $6.5 billion in 2026 and 27. Celestica had been facing high expectations going into the quarter, with the stock rallying 51% over the last month. Let's get to the movers, the movers on the market. For the TSX, we've got it up today 214 points, 0.6% to 33,603. South of the border, a streak of red here. The S&P down 36 points, or 0.5%. The Dow Jones, a 64-point drop on the day, or 1.1%. And the Nasdaq down over 200 points, down 0.8%. Markets watching rising bond yields and energy today. My next guest is also watching what comes out of that update from Ottawa on the Sovereign Wealth Fund. Joining us now is Martin Pelletier, Senior Portfolio Manager, Trivest Wealth Council. Thanks for joining us. Good to see you. Can you explain when you look at the wealth fund and how it affects bond yields?
Yeah, and so this isn't a traditional sovereign wealth fund. I don't even know why we're using that term per se. Sovereign wealth funds are built from surplus capital, typically accumulated from trade surpluses, natural resource revenues, or excess fiscal revenue, none of which exist in this country. So we have a country running persistent deficits. So this could be a debt-funded fund. And that means a worsening fiscal position for the country. And that means yields, bond yields, government bond yields, could face some pressure if this continued fiscal irresponsibility, I call it, but fiscal spending continues. And we've been blessed with lower yields compared to other jurisdictions like the UK or even the US. And that's beneficial to us. But that may not always be the case. So if yields go up, not good for bondholders, Canadian bondholders, not good for people who have mortgages, because mortgage rates will go up, not good for cap rates for real estate, not good for lines of credit, not good for small business. So we do worry that this sovereign wealth debt fund is going to put pressure on yields and pressure on Canadians.
Yeah, there haven't been many details about how the fund will work. What are the details you're looking for?
Well, one of the things I'm really watching for, and it was in a Carney interview yesterday, he said his exact words were, we're not exact, but pretty close with it. Wherever there was a federal participation, acts as a catalyst for projects within provinces and are supported through taxation or regulatory alignment, and then there's a commercial enterprise associated with that in the core of such projects, that Canadians should directly share in the profits. And that was really concerning. Does that participation imply a mandated profit sharing as a condition of regulatory approval? What form of participation does that take in reality? And will that drive capital away, not to? And so I want to get some clarity as to exactly what does that profit sharing mean. And it's certainly, I think it's adding a layer of uncertainty in an already uncertain time for Canada.
I know that they have a fund, and there are funds, nations that have, but Norway has one, I think, that's doing quite well. And I'm wondering why you think that fund is doing well. What draws people in for this kind of thing?
Well, Norway's in a completely different situation. They're receiving an excess amount of revenue from their resource sector and energy sector, and so they've been able to save that, sock that away. Whereas the resources side and the energy side fall under provincial jurisdiction, and to be honest, those jurisdictions, Alberta and Saskatchewan, have not been able to save over the years. We have a heritage fund that's been, somewhat mismanaged per se, but the numbers should be bigger than what we have. And now you have the federal government coming into provincial jurisdiction per se, maybe, and saying we want to create our own sovereign fund. So I don't think you can really draw parallels to Norway in any manner, given the situation and the differences between the countries here. And I think we have to ask ourselves, is this going to be funded through debt, and how is it going to be funded? Where is it going to go? It's very top-down driven. And we saw examples of how poorly mismanaged that was through the infrastructure bank, where only 60% of the funds have been deployed, and we didn't even know the return on those funds. And I just worry as a Canadian taxpayer, as an investor in the Canadian economy, that we could see more of the same.
Okay, I do want to get your take on OPEC announcing that it's going, or the UAE leaving the OPEC cartel. And I'm wondering if this is going to affect Canadian energy at all.
Yeah, this is a pretty significant development. I've read some people say it's noise per se, whatever the case may be, but this is a major development in my mind. You have a destabilization in the Middle East through Iran and the Strait of Hormuz, and you had OPEC for the last couple of years doing a fantastic job of providing some sort of oil stability, price stability. And that's important because you want to have an oil price high enough that you substantiate continued investment. And if it was a free-for-all and UAE is able to add another 1 million barrels a day on the market, whatever that number is, maybe it's more, then that's going to provide less of that stability. So going forward, once we get through this shutdown, and hopefully we get through it sooner than later, we're going to have a situation where there isn't that kind of stability. And so I do worry about it. I do worry about the lack or loss of control over the oil market. So that means big swings in either direction, and that means less investment in oil and gas. And for Canada, that means it's going to be really hard to predict long-term projects when you have that volatility. And we can't even get that oil in the market, and we're selling it at a discount to the U.S. We get some of it done through the TMX, which is a positive development. But that means we're going to lose out on market share, and countries like the UAE is going to steal that market share, and we're going to be left behind. Okay,
I do want to get to at least one stock pick from you. I know you like the build-out, the infrastructure build-out that will happen with the government investments. So give me one of the stock picks under that banner.
Well, I'm going to go with one very close to home for Mark Carney, Brookfield. It was suggested that, from what I've read, that the whole idea of this fund was provided through Brookfield in a couple of years ago. Very well-run company, very professional, very focused on the bottom line, and hedging out the cost structure with inflation. And obviously, they've got some good connections. So Brookfield Infrastructure is a great international infrastructure company that is benefiting from a loss of competition from higher interest rates globally. So they're getting some stronger returns. Also like WSP Global, who's going to benefit from some of the spending closer to home in Canada. So the infrastructure side is one way of benefiting from maybe some of this sovereign debt fund spending.
Martin Pelche, got to leave it there, sir. Thank you so much for your time. I appreciate it.
You betcha. Take care.
A former president of the Minneapolis Fed joins us to preview the U.S. Fed rate announcement. That is tomorrow. That's coming up. Stay tuned. The U.S. Federal Reserve will announce its interest rate decision tomorrow. It's widely expected to leave rates unchanged. Joining me now is Narayana Coach Lakota, former president of the Minneapolis Fed, now at the University of Rochester's Simon Business School. Thanks for joining us today.
Thank you for having me on.
So the March headline inflation number in March was hot. Core inflation more muted. Do you think that the oil prices, which have been elevated, are going to bleed through to core if the war doesn't end soon?
I'm optimistic that that won't happen. I think that, but the solution to this problem is simply to keep your eye on core and see where that's heading. I'm optimistic that the impact of the war will be only on headline, and in which case I think the Fed will tend to look through that impact in terms of setting monetary policy.
Let's talk about job numbers, the other part of the Fed's mandate. The report was better than expected, but we know job numbers often get revised down. So what position does this put the Fed in when it's trying to weigh the labor market situation?
Yeah, I think the labor market situation is quite complicated right now in the United States because of the impact of immigration policies. So in the latter part of the Biden administration, I think there was elevated employment increases because of the impact of new immigrants. And then under the current administration, of course, they've been working to curtail immigration, and that has led to muted employment increases. I think the solution to this is for the Fed to focus on really what the number that really matters to them, which is the unemployment rate, and that captures then what the fraction of Americans who are looking for work and not able to find it. And I think that is a better measure of the kind of resource underutilization that should be of concern to the Fed. That number has remained relatively stable. We've seen a little bit of an uptick in it. But it's we're talking about a number in the low fours, and so I think I think we can think about the U.S. as being close to maximum employment, although maybe not literally there.
Okay, so if the Fed does not change the rate tomorrow, what do you think will be the key reason that they give?
Oh, I think that the key reason they'll give is this is a time to be engaged in a wait-and-see approach to interest rate movements. They're going to, I think they're going to want to see the impact of the new shock, which is the war in Iran, on both unemployment and on inflation, and get more information about that before making an interest rate move. And I think that's what they'll communicate on through the statement and the press conference will be really leaning into this wait-and-see kind of approach.
How do you think Kevin Warsh will change policy? Of course, he'll come up in May, and I'm just wondering what you're looking forward to seeing from him.
I would love to have more clarity from Mr. Warsh. I think he has not. He's suggested a great deal of unease with the reforms of transparency-oriented reforms in the Federal Reserve over the last 20 years. In terms of how they communicate about policy, in terms of, for example, in the press conference, in terms of the use of forward guidance. I think these are reasonable statements to make, but I think we need a substitute. What exactly is a Warsh Fed going to look like? I'm not looking forward to it, but I anticipate a rather bumpy transition. I think it's clear that we're going to see a change in the way policy is conducted, but how that change will work and what it will mean in terms of how markets interact with the Fed, I think it's very murky.
Okay. Do you expect him to align, as many do, with the president?
So I think my main concern about Kevin Warsh has been not so much his ability to have independence from the president. I think I worked with Kevin Warsh during my time at the Fed, and I think he's a very independent person. So I expect him to be independent of President Trump. Where I felt more concerns about Warsh is really in his ability to lead the collective that is the Federal Open Market Committee. How will he communicate his ideas? How will he use evidence in order to marshal change within that rather complex organization? That's where I think the uncertainties lie, and where my sense of one of my sources of unease about the transition comes about.
And is that just because his style of communication, or just because, as you mentioned, there hasn't been a lot of transparency about how he's going to conduct that to date?
I have to say, all of the above. I think what Warsh has communicated is he feels that the models that the Fed uses, the framework it uses, the tools it uses, he's just talked about how he's uneasy with all of these. Again, these are very reasonable perspectives to have, but there has to be some kind of notion of a replacement framework and a replacement mode of communication. How exactly is a Warsh Fed going to make decisions about monetary policy, and how is it going to communicate about those forces that lead it to make decisions about monetary policy? I think that all this is unclear and has to become clear pretty quickly after the change in leadership.
Yeah, there'll be a lot of pressure to do that, to do just that. And Narayana Kocherlakota, sir, thanks for joining us. Appreciate your time.
It's my pleasure. Thank you.
We are just minutes away, of course, from Ottawa, giving us the spring economic update. We'll preview what could come in just a moment. The Prime Minister announced that the upcoming spring economic update will feature good news. Let's talk about what that could be with Charles St. Arnaud, Chief Economist at Service Credit Union, former Bank of Canada economist. Great to have you. Thanks very much for joining us. We're all expecting a reduced deficit as the big highlight today. But considering tariffs, how do you think Ottawa would have been able to reduce the deficit?
Well, that's the thing, is that the smaller deficit mainly comes from, in some ways, better economic activity. We had some positive revision to GDP post-budget, so they kind of know that now the level of economic activity this year is higher because of that. But also we have some tailwind coming from stronger nominal growth because of the higher oil prices that we have right now. Obviously, it comes with benefit on some areas, but also some negative on the other areas. So that's kind of why we're seeing, or we'll see, a smaller deficit than expected, especially as a share of GDP, and the same on the side of the debt level, that we could see lower debt to GDP levels.
Okay, and just to give viewers the numbers, in the fall, the budget estimate for the deficit for the year was at 78.3 for the fiscal year. And there was an update recently as to where we're at, but the March numbers weren't included in that. And I know March is typically a big spending month, so how much could that offset?
Well, the thing is that we're probably going to see a deficit that's about 5, maybe 10 billions lower, not necessarily massive. The question is also that we've had also a lot of new announcements in recent months, whether it's the fuel tax cut that we've had for the next few months. So we'll see how that goes. But then the big question, I think, is when looking at the outlook, is how much of that spare capacity that we've had, or that from smaller deficit, how much of it is going to get spent in the coming year to support, whether it's households and with affordability, or whether it's to support investment.
Gerald, how does the Canadian economy right now stack up against the other G7 nations?
Well, that's where it's actually interesting. We're doing actually okay. If we compare to where we were expecting to be just a year ago, the impact of the tariff hasn't been as bad as we expected. Of course, there's some big strain on key sector, whether it's steel, aluminum, and the car industry. But in general, we're holding up. And what has been very interesting is when we look at the first few months of the year, we were seeing better business confidence, better consumer confidence, and we're kind of giving some hope that the economy was picking up from obviously a low point, but we're seeing some improvement. However, with the energy shock, it's not clear, and the longer it lasts, how much that will have a headwind on our growth going forward.
Oh, let's talk about the Sovereign Wealth Fund. I'm wondering what you think of it, and is it clear to you how it's going to work?
Well, that's the problem, is that we don't have any details. And in some ways, I'm really hoping that the spring update will bring us a lot more clarity, because it's not necessarily clear how it's going to work. Because yes, we know it's going to be seeded by $25 billion of dollars borrowed by the government, but usually sovereign wealth funds are financed through revenues from natural resource and all that. So it's not clear in the future whether we're going to continue to invest and where those funds are going to come from. And then there's a lot of uncertainty in terms of, okay, what will be the objective of the fund exactly? How is it going to be managed and all that? So we'll need some clarity on that front.
You've drawn a comparison to the Canada Infrastructure Bank. How do you compare this sovereign wealth fund to the bank? Are there challenges that could be similar here?
Well, and that's the thing is that both seems to be linked to supporting investment, but it's not clear, are they considering the same type of investment? It seems like the sovereign wealth fund might be more investing into those projects that are making the major project list. So it's not really clear. What I think, though, is that what we'll see from the sovereign wealth fund is not, it might be more kind of participation from the government in those projects rather than outright giving some support and things like that. But again, the details are very small and scant. So it's hard at this point to really make a good point in terms of what are the difference between the two.
As you know, the CUSMA review is still to happen in the summer, a little bit later, perhaps. How much could that affect our economy moving forward for the rest of the year?
That's the big question, is that right now what we're seeing is that it's, again, some uncertainty in terms of what is going to be the outcome of those negotiations. However, we need to look also in terms of how are those negotiations are going to go. And we have to keep in mind that even if Canada and the US do not reach an agreement, CUSMA still stays in place until 2036. The only way CUSMA is no longer in place is for one of the two parties to leave. And unless the US does it, we're still with CUSMA even if we don't reach an agreement. So at the moment, I think it's a low probability, but obviously that increase uncertainty is not necessarily helpful for businesses.
Do you think a bilateral agreement with the U.S., if it goes that way, would be beneficial or would it be negative?
I think it depends on the details. I think it's clear that when we look at the Canadian government's position, which is the right one, it's like, well, we already had a free trade agreement with no tariffs. Why should we sign something where we actually basically accept those tariffs in the long term? So I think that's, in some ways, that's what they're trying to avoid. It's trying to avoid what some other countries have done. It's basically formalizing those tariffs within their trade agreement. So, and that's the way it should be. We shouldn't be accepting something that's not good for our economy.
Charles, I got to leave the conversation there. I'm out of time with you. Thank you for your time today.
Thank you for having me.
Up next, the closing bells, Bay Street, Wall Street, and our special coverage of the spring economic statement. We're back in a moment. Here are the closing bells for the end of the trading day at the Nasdaq Nickel and Mining Inc. ringing the bell. New York 3M Company ending the day. And of course, we're keeping an eye today on Ottawa. We'll take you live there when that spring economic statement gets underway from the finance minister. Let's take a look at how the markets ended the day. The TSX dropped 233 points today, down 0.7%. The S&P down 35 points, or about 0.5% today. And the Nasdaq, a drop of 223 points. It is down 0.9%. As we mentioned, we're waiting for the finance minister to deliver the spring economic statement. We expect him to share that the deficit is going to be much lower than forecasted when the budget came out in the fall. The Prime Minister today hinting at some good news in the update. While we wait for things to get underway in Ottawa, let's go to Charles St. Arnaud. He's Chief Economist at Service Credit Union, former Bank of Canada economist. Charles, welcome back. Let's talk a little bit about what could have led to this lower deficit. Obviously, higher revenue. Where would that have come from?
Well, part of it comes from a slightly better economic performance since the budget. We've seen the economy doing relatively well, but we also have, when we look at more of the forecasting part, we had some positive revision to GDP late last year that kind of raised the level of economic activity going into 2026, and that will, in some ways, push government revenues or the expected revenues for this fiscal year.
Okay, so let's talk about the fact that at the end of February, of course, is when the conflict in Iran got underway. That means Canada's going to make more money on oil exports. So could we see a big bonus just in the month of March?
Well, we'll see some, but it happened more kind of mid-month, so it's not necessarily going to be right away into March. We'll probably see most of it in April, probably May. It takes a bit of time to really start to feed through in terms of higher government revenues. But it will definitely be a slight positive, at least on the revenue side, but we have also to take into account that it's going to also be a headwind on economic activity.
That being said, we know the government has big spending plans. They want to build out a national infrastructure project. So how quickly can that deficit, which may be down, go back up?
Well, that's the thing, is that we've already seen some spending announcement over the past few months. We can think about the fuel tax cut that we've had, last week. So that will reduce some of the revenues and eat up on some of the better fiscal position. When it comes to the investment, that's a bit different. That's more on the capital spending side. So it's a bit less of, in some ways, of a worry per se, but it might not have that much of an impact on the deficit. But it feels to me that a lot of the gained fiscal room from better revenues is going to be spent.
Okay, so let's talk a little bit about affordability, because we know that's a big agenda for this government of late as well. They have suspended the gas tax. They are looking, or have given people grocery money. So that money is a little bit more than they would have gotten before. And I'm wondering whether you see that all as necessary, and perhaps are we expecting more affordability announcements today?
Yeah, well, it's clear that in the mind of the voters, affordability is really key, and we've seen those measures. Obviously, we can always think the fuel tax is often kind of a mitigated impact, because we already can see in a lot of places around Canada is that we've had a re-increase in gas prices.
I'm sorry to interrupt you. We are going live to Ottawa. The finance minister now sharing that economic update.
Drawing on Canada's unique strengths and capabilities. We have the most educated workforce, Mr. Speaker, something we should all be proud of. We have yes, we should applaud all our people, the strong people we have in Canada. We have a very strong industrial base that builds ships, cars, and planes. We have critical minerals to power the economy of the 21st century. We are an energy superpower in renewables and conventional and nuclear energy. We are the only G7 country with a free trade agreement with all other G7 nations, giving us preferential market access to 1.5 billion people around the world. This is Canada, Mr. Speaker. This is the Canada we can be proud of, a country that is strong, a country that is ambitious, a country that is confident. Above all, as the Prime Minister said, let's lead with the strengths of our values and the value of our strengths. Canada is resilient. Canada is resourceful. Canadians are resourceful people. So together, we can chart a path forward to the fog of uncertainty, because Canada has what the world wants and increasingly needs. We have the right plan. We're building big. We're moving fast. And the good news, Mr. Speaker, we're just getting started. And I know in their heart, Mr. Speaker, that my conservative colleagues also feel the same. I can see that across the aisle. Mr. Speaker, those are serious times, and Canadians expect us to be good stewards of our economy and manage our public finances with thoughtful fiscal discipline. Au cours des 6 derniers mois, nous avons aidé les Canadiens avec des mesures concrètes.
Concrete measures to make everyday life more affordable whilst strengthening our economy. And we have built the second fastest growing economy in the G7, whilst reducing our projected deficit for 2025-26 by more than $11 billion, Mr. Speaker.
Mr. Speaker, this is the essence of being strong fiscal manager, to make sure that we made the right decision, Mr. Speaker, to ensure not only benefits today, but for future generations. Mr. Speaker, our economy is resilient, driven by GDP growth, rising incomes, and obviously more jobs. Let me be clear, Mr. Speaker, this is good news for Canadians. It reflects a stronger, more productive economy. And we have made this happen through pragmatic and targeted investments, to making Canada the most competitive jurisdiction in the G7 for investment, including to the productivity superdeduction, and through our trade diversification strategy, Mr. Speaker. And we have ensured that as revenues have grown, two-thirds of this increase over the past year has been directed toward affordability measures that make a real difference in the lives of Canadians. This is the true essence to be Canadian, Mr. Speaker. Guided by our commitment to spend less so we can invest more, and building on the comprehensive expenditure review, our government continued to reduce spending, improve efficiency, and deliver better value for Canadians. As a result, Mr. Speaker, projected deficits are lower over the fiscal horizon.
Great job.
Deficits are lower over the fiscal horizon. We also remain firmly on track to balance day-to-day operating spending with revenues by 28-29, and to keep the deficit to GDP ratio on a steady downward path. Mr. Speaker, this country is going at unprecedented speed. Just to put that in perspective, Canada is the second fastest growing economy in the G7. We're growing almost twice as much.
We have been listening to the finance minister in Ottawa delivering the details of the spring economic update. A smaller deficit, as was predicted, is what we heard from François-Philippe Champagne, over $11 billion less than anticipated. Let's go through the details with John Manley, former Finance Minister of Canada under Liberal Prime Minister Jean Chrétien. Thanks for joining us today.
Not at all. Hi, Marilla.
So the Prime Minister had earlier said, we're in good shape. There's some good news coming. We heard now the deficit is $11 billion less than anticipated. What's just your first read on what you're hearing?
Well, they got a little better outcome, and they're stressing at the outset of the speech all the good news that they've got. But I think the reality is still going to be that we're borrowing a lot of money. I think it's justified in the circumstances because of the challenges that we're facing, both on an economic front with the trade disruptions with the United States, but also on a security front with the United States really withdrawing some of its security guarantees and forcing Canada to spend handsomely on security and defense. So I think they've got themselves in a situation where they're doing what they have to do, and they're going to try to make it feel as positive for Canadians as they possibly can.
We heard both the Prime Minister and the Finance Minister say Liberals are good fiscal managers. But did the government really just get a windfall from the fact that the economy did a little bit better, and maybe from oil prices, which are up?
Well, I think that they benefited from both. As to who's a good fiscal manager, sometimes, it depends on the circumstances. And, Liberals under Justin Trudeau were probably not great fiscal managers. They were spending heavily well before the pandemic put things completely into a tailspin. But when Stephen Harper was elected, he inherited years of balanced budgets from the Chrétien and Martin governments, only to spend into deficit when the global financial crisis hit. So you've got to spend according to your means. You should always be reducing deficits when the good times roll. And that's the greatest flaw of the Justin Trudeau Liberals. And you've got to spend when things get troubling. And I think that was certainly what the Harper government did. It's what the Justin Trudeau government had to do during pandemic, and it's now what the Carney government is going to have to do in light of the many uncertainties that President Trump has thrown our way.
Okay, so we talked about the savings for the deficit, but there's $37.5 billion in new spending coming out in this update today. Part of that will go to a skilled training program for workers. They want to train 80 to 100,000 workers by 2031 for new opportunities. Something like this needed right now?
Oh, I think so. I regret that we didn't do more of that in the aftermath of the implementation of the free trade agreements with the United States and Mexico back in the 90s, because there are, the upside is economic growth, the downside, and we're seeing this with the applications of artificial intelligence, is that while you get growth and while you get increased productivity, you can also lose jobs. So helping, you can't necessarily train everybody to do something that's available to them, but I think that becomes an essential feature. So I think that's the right thing to do. I think some of the other elements probably you've got to look at each one and say, is this really going to increase our productivity? Training people does. It gives them skills and knowledge that they can use in order to fill other jobs. That's good.
Okay, so let's talk about the Sovereign Wealth Fund and whether you see that as being a bonus to the economy, a $25 billion investment to start it. But where does that money come from?
Undoubtedly, it'll be borrowed, but I think it has to be understood that that isn't an expenditure. That sits on the balance sheet of the government as an investment. Now, it depends really how wisely it's spent, but clearly there's need for capital. Personally, I like the approach because I'd rather this kind of money be managed by people that have I lost you?
No, we're still here.
Okay, I've lost your picture. I think I'd rather have this managed by people who are trying to get a return on the investment rather than have it completely run by on the political level, where I've been there, where you're subject to lobbying and pressures that have to do with politics, but don't necessarily get you the best outcome. So I think this is a good way to put government capital behind some of these big projects without being completely subject to the political pressures that could end up causing the funds to be wasted.
John Manley, got to leave it there, sir. Thank you very much for your time. Very much appreciated.
My pleasure. Thank you.
All right, let's go to Joe Oliver now. He's a former finance minister of Canada under Stephen Harper's Conservative government, also a former Minister of Natural Resources. Thank you for your time today.
Delighted to be with you.
What's your first reaction to the headlines of the update?
Well, the deficit isn't quite as bad, but we understood that was going to happen because of higher oil prices. I mean, we still are looking at profligate spending, frankly, and no intent, as to my knowledge, to get out of a deficit situation as far as the eye can see. So this is, I don't know if it's exactly a Justin Trudeau redux, but it is, very similar in terms of fiscal policy, and that's sort of disappointing. His signature new initiative, the Sovereign Wealth Fund, I have to say is quite problematic. It may not turn into a slush fund boondoggle, but it has some inherent problems associated with it. There's a lot of reference to the Norwegian fund, which is a $2.2 trillion fund, highly successfully run. But there are two fundamental differences. The first is that this came from offshore oil and gas revenue. In other words, it's a wealth fund. In this case, in Canada's case, it's going to all have to be borrowed by the federal government or by the fund itself with a federal government guarantee. And so interest will have to be paid and additional debt, of course, incurred. The other fundamental difference is that 100% of the investments in Norway are outside the country. In this case, most, if not all, will be inside the country, which raises questions not only about return, but about where the money will be going and whether this is the most effective way to use borrowed money and whether money should in fact be borrowed. If the projects are economic, if the government gets out of the way in terms of regulation, there should be plenty of private capital willing to invest. Okay. If, on the other hand, the profits are the projects are highly risky or potentially unprofitable, then the government, of course, shouldn't be getting into it, and the taxpayer will end up paying the bill.
Let me interrupt
Sure.
for a moment. I want to ask you, because you started about the deficit and the high spending, some of which we understand where that money will go to. But even with the extra revenue of $11.5 billion, taking the deficit down to high 60s, the Conservative leader says the deficit should be capped at $31 billion. So are you sort of in line with him at where the deficit should be, or do you think it should be greater given the transition the country's trying to go through?
I don't want to put a direct number on it. I think it's too high, and I think that the fact they don't have a target is to get into a balanced position is very, very problematic. They, as John Manley was saying before, in times of economic growth, you want to be in a balanced or even surplus position so that when the economy takes a downturn, as it inevitably does at some point, you have the resources and to create the stimulus you need to counter the downturn, which is what Jim Flaherty and Prime Minister Stephen Harper did. And fortunately, they were able to do it, but they always had in mind getting back to balance. And when I became Minister of Finance, I was able to deliver a balanced budget because of all the hard work that they had done before. That's the fiscally responsible approach to management, and we're not really seeing that at all.
Okay.
And that's what concerns me.
I do want to ask you if you see obvious cost savings that are evident to you. We know that there's more spending in this announcement, upwards of, I think, $37 billion. Part of that will go to a skills training program for workers, for example. But where do you see money being saved if you do see an obvious way to save money?
Well, look, I can't get into the specific details, but we have a productivity problem, a capital flight problem, and it's manifested in our GDP growth, which was insipid for a period of the last dozen or so years, and we've fallen behind most OECD countries. In fact, we ranked second to last, and we've fallen behind the United States by about 20% during the last decade or so. So we have to do something about that systemic problem, and the way you deal with it, there are a number of ways to deal with it, but reducing regulation is one of them. Creating a competitive tax regime is another. Getting rid of interprovincial trade barriers, removing the impediments to natural resource development, and containing spending so that you have a little bit of breathing room to focus on research and development and defense spending, which is critical. We've got to strengthen ourselves, particularly because we have a challenge in terms of our trade relationship with our biggest trading partner, the United States.
Yeah, and that review still to come. I got to leave it there, sir. Joe Oliver is former finance minister for the country under Stephen Harper. Thank you for your time.
Thank you.
Coming up next, we will continue our coverage, take a deeper look with an economist in just a moment. Stay tuned.
We've built the second fastest growing economy in the G7. And I want to put that in perspective. If you look at the numbers, Canada is growing almost twice as fast as what you see in Germany. Canada is growing twice as fast as what you've seen in Japan. Canada is growing 3 times as fast as what you see in Italy. And at the same time that we've been able to achieve to be the second fastest growing economy, we have lowered our projected deficit for 2025, 2026 by more than $11 billion. This is at the core of being fiscally prudent.
All right, the finance minister in Ottawa, he brought us the spring economic update. We also know Jimmy Jean, chief economist and strategist at Desjardins, has been in that lockup all day. He got to look at the details ahead of the rest of us. Jimmy, you heard that the finance minister is calling this a fiscally prudent update. Would you agree?
Well, we're certainly entitled to good news in today's update. So we have lower deficits than were projected back in the budget. But this is largely due, so it's not a big surprise because it's largely due to GDP revisions. So with growth being revised higher and what this means for government revenues, that's where they can collect a pretty significant windfall. Part of it, they also reinvest into the economy, so they respend portions of it. We had previous announcements on supports for households in particular. But at the end of the day, they were still able to generate some savings out of this and seeing deficits on a lower trajectory. So I think this is positive. Having said that, it's still a very challenging environment out there, so we have to brace for the possibility of the government needing to intervene a bit more, depending on what happens in the next few months.
Yeah, we heard the finance minister earlier today talk about the fog of uncertainty that we're still in, and there's new spending in the update. Is it money well spent?
Well, when you talk about support for households, let's say the grocery benefits, certainly households have been struggling with the price of groceries. You take the Canadian CPI for food, and it's 20% above its pre-COVID average. So just the cumulative effect of price shocks has been very significant. So I think they responded to a political pressure on that front. And same thing with gasoline and how that affects consumers that are struggling. We know the job market is weak right now. It's softening. More than 100,000 jobs lost since the beginning of the year. So I would argue that to some extent those measures have been relatively well targeted. And it's the government just playing its role in a more challenging environment. Having said that, really the big focus is going to be on the building, the infrastructure, on the defense parts of it. And I don't think today's statement really moves much the needle versus what we've already known. It's really going to be about execution, and we don't have a firm sense as to where we are moving on that front.
Okay, you mentioned some of the affordability promises here. The grocery credit is going to cost the government $10.6 billion over 5 years. The fuel tax about $2.4 billion when it ends in September. But you're saying it's money well spent. There's also a training program that was announced today. Did you think that was needed?
I think that's the best part. I think the key highlight in this budget is the amounts to help in delivering skilled workers in the construction industry, because this was an area that was sort of overlooked amid all that rhetoric about ambitious building plans, the infrastructure projects and everything, but knowing that there's a very important labor shortage issue in the construction industry. So I got to say, it's the first time I see in the last few years that I see a fiscal document address that issue head on, and we'll have to see, how that materializes, how they work with provinces, particularly because that's kind of their jurisdiction. But I do salute the recognition that the jobs and workers in particular are the biggest bottleneck to the ambitions they're putting forward. So if you want to execute this properly, they're going to need the workers. So this is going to help.
Okay, let's talk about sovereign wealth fund. There have been a lot of questions about how this is going to work. Was there any clarity in the update?
No, short answer. We don't really know how this is going to be financed. So there's no explicit acknowledgement of how they're going to raise the 25 billion seed money to fund this. We don't have much in terms of how retail investors will be able to participate. So this still seems like a work in progress. I think the comments made yesterday about, for example, how this is going to overlap with several funds, including from the federal government, but several other entities at various levels in Canada. So really, what role and what place will this fund play? How will it succeed where other similar funds have been underwhelming? Those are still open questions. I think they're going to develop this, they're going to refine their approach going forward. But it does feel like it was more a preliminary statement on this, and that we're going to get the fuller version later.
All right. Jimmy Jean is a strategist at Desjardins. Appreciate your time. Thanks very much, sir.
Thank you.
Coming up, the Canadian Federation of Independent Business wants more help from Ottawa for small business and entrepreneurs. We'll talk to Dan Kelly, President and CEO of CFIB, in just a moment. We just got the spring economic update from the finance minister in Ottawa. In lockup today and poring over the 167 pages, Bloomberg's Toronto bureau chief Melissa Shin. She joins us now with details. Melissa, thanks for joining us. What would you say is the key headline from the update? Is it deficit reduction?
The deficit stayed about the same. It is lower for this year. It is now about $67 billion, down about $11.5 billion. So I guess it's not really the same. But after this fiscal year, the numbers are pretty similar to what they were in the November budget. So there was a windfall that came as a result of higher oil prices and also a bit of expansion in the economy. But that has been primarily redirected towards spending.
Okay, let's talk about the Sovereign Wealth Fund, which was just announced, and a lot of questions about how it's going to operate. Did we get any answers in the update?
Not really much more than we heard yesterday. So as we know, the Sovereign Wealth Fund was shared publicly yesterday, and then a lot of people are hoping for a bit more information in the budget, in the economic update, but it doesn't seem like there was much more. It sort of reiterated everything that we saw in the backgrounder yesterday. There was a nice diagram with a little bit more information, just sort of reiterating and giving slightly more detail on some of the more specific parts. But generally speaking, for your viewers, there's not much more information.
Okay, there are governments pitching this as an affordability budget, right? Maintaining some momentum in the Canadian economy, but also making life more affordable for Canadians. Was there an update on that front?
Well, one thing that some people might appreciate is that as of Jan 1st, 2027, there will be a reduction in CPP deduction that will be put on people's paychecks. So it will go from 9.9% to 9.5%. So that is going to work out to about $133 for someone who is making $70,000 a year.
Okay, some dollars and cents to look forward to. Melissa Shin, thanks for joining us. Appreciate that. So the Canadian Federation of Independent Business warns that neglecting small business will weaken the country's economic resilience. So as today's spring economic update offer the help that they've been looking for. Let's go to Dan Kelly, President and CEO of the Canadian Federation of Independent Business, to talk about that. Dan, what's your quick take so far on the spring update?
Well, a bit disappointing. If we've now had 6 quarters in a row where there are fewer small businesses than we started, I don't see anything in this that's going to cause us to stop that descent and perhaps have a 7th quarter of negative business growth. That's not at all what we need. There were a few good measures, but you know that, as you just discussed, the deficit remains sky high, and we've got lots and lots of other worries.
Okay, let's talk about what has chased business out of business. Tariffs were a big part of the conversation the last sort of year and a half, and I'm wondering how much of a hit small businesses took from that.
It's been significant. Remember, a lot of small firms struggle to qualify under the Kuzma rule, so that has been a particular pressure on them. But this started even prior to the tariff fight with the United States. We've seen now, since 2024, a steady descent, a smaller number of businesses each quarter than we started with. That almost never happens. Even in tough economic times, recessionary times, there are typically more business starts than businesses wrapping up, and the opposite has been true now for 6 straight quarters across Canada. And we needed something fairly significant to be able to halt that, to send a note of optimism to Canada's business community. And while there were some measures we like in this statement, that's not unfortunately going to be enough. The big one, of course, is the Canada Pension Plan reduction. That is good news. Payroll taxes are particularly tough for small businesses to swallow. They tend to be very payroll intensive. And so any reduction in CPP premiums is good news for small firms. It'll put more money in the pockets of workers and in the pockets of the payroll budgets of employers.
Okay, let's talk about the 1 or 2 things you would have liked to see that you did not.
Yeah, we were looking for a big measure, and particularly we were focused on the small business corporate tax rate. It has been over a decade since we've seen any reduction in that rate, and we are very focused on Ottawa to see that reduced. It's 9% now. Many provinces have been lowering their rates. Ontario just did a big drop, about a third reduction in its rate very recently. So we'd like to see that happen at the federal level from 9 to 6% specifically, or an increase in the threshold above the $500,000 current threshold. We think that would be a big measure that would get a lot of small business owners excited. Remember, we spent about a decade telling business owners that businesses are a way to cheat on your taxes. We're not particularly worried about you, and we need to turn that around.
Okay, today is the 1-year mark for Mark Carney being elected. I just want you to give me a rating on his first year in office, if you can.
Well, look, I think there's been he's done as much as could be done on the international trade front. While we don't have a deal, I don't, there has at least the wheels still seem to be on in Canada-U.S. trade. The majority still flowing across the border tariff-free. Unfortunately, though, on the domestic policy front, domestic economic agenda, very little has happened towards small firms. The fall budget, the spring economic update, we're looking for significantly more than some of the measures today. I like the apprenticeship focus of this budget. That's a good one. But we need more measures like that if we're going to have a hope of trying to turn this around.
I'm going to leave it there, Dan. I know you're tight for time, but I really appreciate you squeezing us in. Thank you.
Anytime.
After the break, the government's plans to turn big energy projects into jobs, investment, and long-term security for Canadians. Back in a moment. We just heard from the finance minister. The spring economic update was shared about a half an hour ago, 4 p.m. Eastern time. But reporters from CTV News and Bloomberg have been in the lockup for hours, so all day long, going through the documents page by page. CTV's Mike Couture brings us the highlights.
It's more than just an economic update, proposing $37.5 billion in new measures over 5 years. A part of that includes a new skills training program. The government hopes to recruit, train, and hire between 80 and 100,000 skilled tradespeople by 2031. The cost of the program is $5.9 billion.
I think what we realized is that we needed to do more. There's no doubt about that. We've seen, there's a number of programs existing, a number of government institutions that have been having different programs to help people in the trades, but we've not seen a comprehensive approach.
While the deficit was $11 billion lower this year compared to last fall's projection, the long-term outlook is largely unchanged, with no path to balance for the next 5 years. And the deficit will remain over $50 billion into the 2030-31 fiscal year.
Any kind of a savings that they get out of the revenues and the spending cuts over the next 5 years, they have decided to spend those. And some of those measures that you mentioned on the pocketbook measure, like the GST credit and those kind of things, these are how they're paying for those.
Royalties from high oil prices are contributing to government revenues, but Canada is facing fiscal headwinds from the ongoing trade war with its largest trading partner.
There's kind of a fog of uncertainty, which is clouding a lot of parts of the world. And Canada, despite all that, has been able to manage to lower the deficit and at the same time making sure we're there for Canadians.
In addition to yesterday's announcement of the Canada Sovereign Fund, there is other new spending. $755 million over 5 years to support Canada's sports system, including Olympic athletes, and $4.3 billion for Indigenous communities. There is one pocketbook measure Canadians could feel. The government is reducing the contribution rate for the Canada Pension Plan. Someone earning $70,000 per year will get to keep $133 more of their take-home pay annually. But there are few other new measures to help Canadians on a daily basis.
I think what it demonstrates is the high fiscal cost to the government of trying to introduce new pocketbook saving measures for Canadians. It is very expensive.
Pressed on that, the finance minister pointed to measures like bolstering the groceries and essentials benefit and suspending the excise tax on gasoline until Labor Day as ways that the government is helping Canadians deal with the affordability crisis. Sandy?
CTV's Mike Couture reporting there. So energy, of course, a key part of Canada's economic future. The government pointing to major projects across the country that they hope will grow the economy and strengthen energy security. Let's go to Heather Exner-Pirot. She's from the Macdonald-Laurier Institute and joins us now to talk some more about what is going there. Sorry, Heather, are you there?
I'm here, yes.
Okay, there we go. We're going to turn up your audio. I can hear you just very softly right now. Did you see anything clearly that updates the energy plans of the government?
Nothing clearly, no. In fact, I was surprised there wasn't too much exciting. There wasn't too much new. I would say, there's a sovereign wealth fund, and we got all the details that were announced yesterday. There wasn't much new in the economic update, but there was the announcement for the trades, $6 billion for recruiting, training, and hiring. And I would say that's probably good news. For all the other things that the government wants to build, baby build, obviously you need people to do that building. And so I think that's broadly positive and industry will be pleased.
I was going to ask you, within your sector, does that mean you're looking for more construction workers, very high-skilled construction workers involved in a plan to build up the way we want to?
I mean, everything. Yeah, I thought we might get details on the upcoming national electricity strategy, the national nuclear strategy. We didn't. But those things will have to happen. We have to build more electricity generation in this country. We have to build more transmission. We have to build more mines. And obviously, we'd like to build some more pipelines and upstream production, too. Okay. You need the welders. You need the electricians. I mean, you need the whole suite of things to build these things.
Let me ask you about clarity on how Ottawa pivots to deal with climate change as it builds out energy infrastructure. Is that plan clear to you?
There wasn't much in there, I would say. They reiterated their nature strategy, and that's conservation. That isn't, too threatening to industry. They did provide some clarity on carbon capture credits. They'll extend it to enhanced oil recovery in a minimal way. So I think that's a little bit, of a bonus, not tremendous. And so not a lot here on the climate side, but not a lot on the energy side, too. I'm guessing it's TBD, and we'll get more updates on those as in the weeks to come.
Okay, so it's been a year for Mr. Carney. You've heard the big infrastructure plans, the national office, the project's office in Calgary, that's meant to fast track a lot of this. So far, we've seen the Port of Montreal actually with shovels in the ground. How would you say this government's doing so far along these lines?
Well, even the government has said, and Minister Hodgson has said, that last year was about the announcements and setting some of the groundwork, but now we have to build. So I think everyone is pretty anxious to get to some FIDs, to get some clarity on some of the big things like industrial carbon pricing. That clarity was not provided today. There are reports that it should be provided soon. There'll be some, conclusion with Alberta on that matter, but it's hard to really advance work when you don't know what that's going to look like for your business. And so still waiting for some of those details to come through. Actually, I thought we might get more today and we didn't.
Okay, because the Montreal port, as you know, those plans were already sort of existing. I'm wondering what you think the next big play should be.
Well, obviously LNG. LNG is going very well. We saw the big purchase by Shell of ARC yesterday. That's a huge vote of confidence in LNG Canada Phase 2. There is some more details on accelerated capital cost allowances in this budget, and Shell has been vocally supportive of the government's approach. BC has also been supportive of LNG. They're not supportive of everything. So I think those are the near-term ones where we're going to get, multi-billion dollar, 10, 20, $30 billion announcements, which we'll look forward to. I think that one oil pipeline is probably going to take a little bit longer.
Are there other initiatives besides LNG, so towards cleaner energy and the path there, that you see the government committed to?
So they haven't in this particular update. They are promising that national electricity strategy imminently. I expect it's very hard to finance hydro and nuclear. I happen to think that we do need a hydro and nuclear, and I expect the government will have to have some plan to help provinces, some of the very smaller utilities, be able to do that going forward. But again, we didn't get any of those details in this particular update, which I was kind of hoping we would.
All right, Heather, I'm going to leave it there with you. Thank you very much for joining us. Heather Exner-Pirot, Senior Fellow, Director of Energy Natural Resources, Macdonald-Laurier Institute. After the break, Canada hit NATO's 2% defense spending target. But let's see what it means for the military and where that money will actually go. Back in a moment. Defense, of course, a big ticket item for the federal government. Let's go to Emeritus Associate Professor of Defense Studies at the Canadian Forces College, Dr. Craig Stone, to talk about this. Thanks for your time today.
Thank you.
Did you hear any noticeable update about defense spending? We know it's obviously a big objective of the government to bolster defense in the coming years, but was there any update from today?
So there wasn't much more than what I expected, which was some generalities about they met the 2% target. There's a table in the document that speaks about that. The only hard numbers that were really in the update, they're allocating $103 million to the Defense Investment Agency. That's a little bit more than what was articulated in the fall budget. And the update section that deals with defense highlights the release of the Defense Industrial Strategy, has some language about, that's designed to decrease our reliance on the U.S. and some general language about economic benefits, but nothing really specific about specific military projects, like the patrol submarine or F-35 issues, other than, like I said, there's that one table that has money on the Defense Investment Agency and an affirmation of the $2 billion that's going to go to the Ukraine.
What does the investment agency do?
So the investment agency is going to fast track or fix defense procurement for those projects that are worth more than $100 million, designed to speed up the process. It is an organization that's taking people from the Department of National Defense, Innovation Science, Economic Development, Public Services and Procurement Canada, bringing those people together under a CEO. And there is going to be legislation sometime this summer to make it a standalone organization and give it some more authorities and accountabilities so that they can actually make decisions quicker.
Okay. I know the military has faced problems modernizing its fleet and modernizing various infrastructure that they have. And that has been a process that's been sort of dragged over decades, really. What do you think should be the biggest focus of this government along those lines?
So the government's really already started some of that with spending money on infrastructure to deal with both new platforms. So when you think about F-35s, they're going to require specific types of technology in their hangars and things, but also to update some of the other infrastructure that's been, as you indicate, let go or not actually done at the industry standard of you're supposed to spend 2% of the value of your infrastructure on maintenance every year, and D&D hasn't done that in decades. So when you read the update, they've got a map of Canada with an indication of all the things that are going on in all of the different provinces, and lots of those bullets deal with infrastructure. And the table that talks about 2% has language on infrastructure as well, but nothing specific about we're spending this amount of money at CFB Trenton. It's generalities.
Would you say there's a focus on the Arctic, which we know the government has talked about?
Yes, and one of the bullets in the table is securing our Arctic.
What does that look like to you?
So when you think about it in the context of Canada meeting the new NATO target of 3.5% and 1.5%, the 1.5% is on broader security issues, and Canada can spend that money fixing infrastructure in the Arctic easily. If you think about it in terms of dual use things, internet access, infrastructure, roads. If you're updating an airfield, you update that so it can serve the military and the commercial activity in the town or the location. So it's those kinds of things that in the Arctic, when you are building things to demonstrate sovereignty from a military perspective, you're doing dual use things that the civilian economic activity can leverage as well.
We were talking to guests today about the fact that it's been 1 year now since Carney has taken the government, and I'm wondering where you would rank what he's done so far for defense.
So when people ask me questions like that, I always say it's too early to tell. He has said all of the right things. The defense policy said the right things. The defense industrial strategy says the right things. The issue is now implementation, and implementation will take time. No matter how fast you try and go, implementation is still going to take time, just because you need the workforce, and the update has money allocated to training skills, so D&D can take advantage of some of that in terms of workforce in the trades, but it's going to take time, and it's too early to tell whether any of this stuff is going to come to fruition. Because the Canadian public 3 years from now can decide they don't want to spend 3.5% of GDP on defense, and then it'll all go away.
Yeah. Greg Stone, great to have you, sir, on the program. Thanks for joining us today.
Thanks for having me. Have a good day.
You too. And thank you for joining us today for our special coverage of the economic update coming out of Ottawa. We'll see you back here on The Close tomorrow.